if you truly want to build significant wealth or financial independence through real estate investing, it's a numbers game. It's a portfolio game. You're not going to do it through one house likely. It's going to require a well thought out portfolio and strategy across multiple markets with multiple assets that are all individual income streams.
Welcome to Redefine Retirement with Wheless, powered by Ally Wealth. This podcast explores how to live a limitless life of abundance in retirement with clarity, purpose, and confidence. Welcome to Redefine Retirement. I'm your host, Wheless. I want to start out today by really answering a question. And we get this a lot at Ally Wealth and client meetings and that sort of thing. It always comes up that, hey, Ryan, I've got this 401k, I've got this IRA. What about real estate? What if I'm not comfortable putting my money in the stock market, bond market, or equity markets, or private equity, whatever it is? Maybe I want to consider utilizing real estate for something to generate income and grow my wealth. How can I do that? We get that question a lot. So I brought on a very special guest today. It's Zach Lemaster. He is the founder and CEO of Redefine Retirement. That's a company that he founded. He's obviously a seasoned real estate investor. Built a solid company, solid system, more importantly, I think that a lot of folks out there can follow. Not only that, he's also a doctor, an optometrist, right? Is that accurate, Zach? Yeah?
That is right, Ryan.
And military background. First and foremost, man, thank you for your service. My dad was a F-14 pilot in the Navy. My brother made warrant officer in the Army. So I'm very seasoned with the military background for sure. And then you kind of transitioned to a full-time investor coming out of the military, I assume. Pretty cool. And then a lot of entrepreneurial ventures. You built a successful wholesaling, flipping, and property management business, which we're going to discuss in detail today, and experiences and contribute to the establishment of Rent to Retire, which is what you do now. A lot of industry recognitions: Forbes, USA Today, Fox News, NBC, CBS, my favorite, Veterans Affairs. Without further ado, please welcome Zach to the podcast. Zach, again, thanks so much for being here. Tell me this, man. You're sitting around, and I'll start with this. You're in the Air Force as a captain, sitting around with your military buds, probably popping out some challenge coins here and there, I would imagine. And what was your thought? I mean, what were you trying to figure out how to get out of the military and transition into the next move of your life or next chapter? Or give me some background on kind of what sprung this thought process.
Yeah, absolutely. And thanks again for having me on, Ryan. It's a pleasure to be here. Love what you guys are doing, helping your individuals protect their wealth first and foremost, and also make smart investments to ultimately accomplish their goals. But yeah, to answer your question, I mean, I was an optometrist. So was my wife. We met in school. I was on scholarship to join the Air Force. So I was on HBSP scholarship. I joined the Air Force after graduating optometry school. I was a captain for 7 years and practiced optometry there. But my first year as a young captain, this is also my first professional job and income. I really wanted to be smart with my capital. That started with me being frugal, but also being conscious about where I was investing. I wasn't one of these military guys like many of them do, go out and blow their first paycheck on a nice car or whatever the case is. I invested my first paycheck, but I bought a house that I lived in, and house hacked, basically a duplex. I rented out half and lived in the other half. But I never had a goal ultimately to build this company, build a very large portfolio, retire myself early through real estate. That happened over time through consistently investing and being a strategic investor about where I invested. But ultimately, when I first started, I just want to be smart with my money. I read some of the Rich Dad, Poor Dad stuff, the Robert Kiyosaki stuff, really got my mind thinking about how to think about assets and investing and think about money. And I decided that I just wanted to explore real estate. Just so happens that I fell in love with real estate. Had proof of concept. It's a tangible asset. And I continued to invest. So, from that first year in the Air Force that I bought my first house, my first duplex 14 or 15 years ago, I've never stopped investing in real estate since then. I'm not saying I've made money on all those deals, but staying consistent to that ultimately allowed us to be to the point where we are today and just staying the course.
So at what point did you decide that you're going to take what your success has been and share that with other people in a way to empower them, enable them to experience the same success you have?
I've always been passionate about teaching. and helping others accomplish, what I have, and that's in the real estate space or otherwise. That's been a big piece of my upbringing, and so that's stayed with me. But my wife and I, when we first started investing, we invested locally just because that's what we knew and felt comfortable with. And then there was this turning point, which was really probably the most pivotal moment for our success that we have today. And that's being intentional about where we were investing. We always hear about real estate being like location, 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 but it's like, well, what does that really mean? For us, it was investing outside of our local market where we saw better opportunity, better cash flow, better appreciation, better growth, diversifying, not having all of our investments in one market. And that was really the catalyst to allow us to expedite our success, because we were able to invest in markets where we were significantly more successful than we would have been in our local market. Now, that took a lot of time and energy to set up those systems and teams, but people started to notice that. People started to notice the success we had. I was very vocal about what we were doing. I attended local real estate meetup groups. I was part of online communities. And so people naturally gravitated towards me to say, hey, we see the success you're having in real estate. Can you help us? Can we invest with you? We don't have the time, the energy, the knowledge to invest. We're not local to these markets. And so it was just kind of a natural progression of helping people basically do what we were doing. We already had the systems and teams set up in these areas. We were already doing the market research. And so we were able to help investors come in and basically replicate exactly what we were doing, to have an entry point into real estate where they weren't making the same mistakes, the new investors do that don't have the guidance. And that was really the birthplace of Rent to Retirement, is just helping some of our colleagues and friends and family do the same thing. And then we noticed that there was a larger community of like, hey, we actually have a process and a system that a lot of people could benefit from, and started to, grow the organization from there.
So when you go out and search the areas, the markets, I guess is a better term, what is it that you're looking for, Zach? I mean, how do you discern a good deal from a bad deal? I guess I'm really trying to come at it from an angle of those that are very trepidatious about getting started because they're afraid of the bad deals and not finding the good deals. So give me some background about how you identify what is a good investment, what is not a good investment.
Ryan, real estate is one of the oldest forms of investing because you're investing in a human necessity. It's housing. People always will need a place to live, and they always have. And so it's a very safe, secure investment if you approach it the right way. And we're talking about bread and butter residential real estate. A lot of people have invested in real estate historically, whether they're an accidental landlord or they kind of arbitrarily bought a property and they didn't have a good experience. And then they've written off real estate as, this doesn't work. Right. And I've been there as well. But what our intention is to find a market, both on a macro and microeconomic scale, identify the locations where the fundamentals of real estate still apply today to set people up for success long term. And so what that specifically means is we focus on finding areas that have an undersupply of housing. A lot of real estate, like anything economically, is driven by supply and demand. And if you can be in an area where you have an undersupply of housing and an increasing demand, meaning the population is growing, you're pretty much destined to be successful. Now, there's a lot of nuance with that, but we focus on areas that have an undersupply of housing, that have a growing population, that have a diversity of industries. We don't want to be in an area that's, just relying on, automotive or oil and gas or whatever, government or whatever the case is, because that could change the economics. We want to see diversity of industries. We want to be in areas that have landlord-friendly legislation, areas that have low taxes. These are all things that are important to consider when setting yourself up for success, as well as being in the price points where you can cash flow positively. We don't work with luxury, high expensive homes that have fluctuation in value. We work in bread and butter housing. These are below the median house price point in the U.S., which is usually about $400,000, give or take. Most of the new construction houses and rehab houses that we focus on are in that $200,000 to $300,000 range. So our goal is to first find a market that meets all these fundamentals, and then we develop our systems and teams in these areas where we can offer either a fully renovated or a newly built house that our team leases and manages for an investor, so they can add that to their portfolio, where we're essentially handling everything for them. So we've already done the market research. We already have the teams established in those areas. So regardless of our investors' experience or time involvement, most of our investors are busy professionals, or where they live. A lot of people can't invest in real estate because they're only focused on their local market, and their local market doesn't make sense, or it's too expensive or competitive. And just as I mentioned in our story, what's helped us be successful early on is not just focusing on our local market, actually selecting the markets that best meet our goals and have the best opportunity. So we make that accessible to them. Again, where they're not having to self-manage a property or try to do things from a distance. We're handling everything for them and being the extension of, of their team in this area.
So what we're really getting at here is, turnkey real estate investing versus traditional property investing, right? So what I'm hearing you say is like, if I have an issue, I don't know, maybe the toilet clogs up and needs to be replaced. Are you guys going to that level of helping the owner of the property to get that toilet fixed through a maintenance company, or are you providing property management services in addition to sourcing houses?
Yeah, all the above. It's a full service management and comprehensive approach to investing in real estate, where management handles everything for the investor. They're not having to, the investor, the owner of the property is not having to interact with tenants. I mean, those are the things, those are the unfun things, right? The non-fun things about investing in real estate that kind of, pull your hair out. And quite candidly, that's not the best utilization of your time. People invest in real estate with the idea of creating, financial independence or some additional, supplemental income that they can receive on a monthly basis. They're investing in an asset that appreciates over time. They're using leverage, which the tenant pays off over time. There's tremendous tax benefits in real estate investing, better than any other asset class out there. I'm happy to get into that. I could spend a whole day talking about the tax benefits, which is one piece that we help our investors with. But no one gets into real estate because they want to manage properties and buy themselves another job. So that's our goal, is to handle everything for them. As well as helping them build a strategy and a plan, regardless of your experience, even if this is your first house, of like, why are you investing in real estate? What is your short and long-term goal? What type of things do we need to consider on the financing side? What location best suits your goal? And then we have the inventory available that we've newly built or renovated, leased and managed, where you can buy those, and our team handles everything for you. So you get the financial benefits of real estate ownership without having to deal with the day-to-day, operational side, and you get access to the markets around the country that offer the best returns.
That's pretty awesome. So you're basically cutting the headaches out, if you will, of investing. And I remember I had a client, Zach, this is 15 years ago, 10 years ago, and they had bought like 30 properties. And they had bought the properties when they were 55, and they were now 85 years old. These properties were 30 years old, but some of them 40 years old, right? And they were starting to deal with a lot of headaches because the properties started to get run down. A lot more things had to, air conditioners were going out, roofs were going out. Several properties had foundation issues, and they were having a really hard time figuring out how to manage through disposing of the properties, and passing that wealth on to the next generation, and figuring out how to manage all that stuff. And that, I remember that being a really big headache. And what it sounds like to me is you guys really are after removing those issues. So tell me some disposition strategies. Are you, if we buy a property, a new build, and we'll get into the new build stuff and the tax stuff here in just a minute, but if I buy a new build property today, 20 years from now, are you guys helping with the disposition of the property as well?
And just to be clear, like, real estate is real estate. You're housing people. Those things still happen, right? You still have maintenance issues. You still have repairs that you need to do on the property. Our team does handle all of those things. As the owner, you're always made aware of how the property is performing and things that come up, but that doesn't mean you're having to deal with them, right? So that's the goal of our team. I think a lot of people, Ryan, in their head think about, hey, if I buy a property, I put a 30-year loan on it in 30 years, or they could put a 15 or 20-year mortgage on it, depending on their situation and goals. But hey, in 30 years or whatever the case is, the property be free and clear. I don't have a loan on it anymore. The house is appreciated in value. Rents have gone up significantly. Like, I got this huge cash flowing property. And while someone could potentially do that, there's probably this optimal time period of sale for the property before you get to the point where you have to put a lot more money into it, especially with new construction. That time horizon is probably between 5 to 10 years. So to answer your question, most of our investors are holding on average between 4 to 6 years. And the reason behind that, and we kind of coach them through this, is because that's the optimal time to sell to increase your portfolio. If you truly want to build significant wealth or financial independence through real estate investing, It's a numbers game. It's a portfolio game. You're not going to do it through one house. Likely, it's going to require a well thought out portfolio and strategy across multiple markets with multiple assets that are all individual income streams. But the 4 to 6 years is usually this optimal time where, say, they buy a new construction house. They've maybe had a little bit of maintenance. They certainly haven't had any capital expenditures or large ticket items. And if they were, they're guaranteed by the builder in their warranty. But they've held this property where during a 4 to 6 year period, the tenants paid the loan down some, the house has appreciated in value, the rents have gone up, so they're cash flowing well. But really, just between the loan pay down and the appreciation, they have significant equity in the house, in addition to their down payment they used to already buy the house. And so usually within that time frame, they can take one house, they can sell it at a gain and and go through likely a 1031 exchange where they don't have to pay capital gains on the appreciated value of the house. And then they're able to roll that into 2 or 3 more properties without injecting any more capital into their portfolio. And it's a tax advantage way. You're not paying taxes on any of that. So it's just trading up. I mean, this is a monopoly game. You're trading up one house for 3, and then eventually you do it again in another 4 to 6 years, and you trade 3 for 10. And we go through the math with people with this, but you're basically, trading up where you're not holding onto a property for its entire lifetime. And this is a strategic way where you can grow and scale your portfolio to increase your cash flow, increase your net worth, and use tax advantages, all the things.
So you're basically, if you buy a property for 200 grand and I don't know, 5 years later, you sell it for 300 grand, you take that $100,000 profit, you do a 1031 tax-free exchange into another property or properties, right? So maybe you bought the $200,000 property, put $40,000 down, right? Now you've got $160,000 of expendable capital plus your $40,000 back, right? Now you're in a situation to where you take that capital and that gain and lever that up and keep building wealth over time.
Yeah, absolutely. In your example, you put $40,000 down on a $200,000 house. That's 20%. You always have that down payment, but the house appreciates in value over time. So in your example, if you sold it at $300,000, that's in theory $100,000 that you'd be paying taxes, capital gains on. More than that if you sell it in less than a year, but say you hold it for multiple years. So that's $40,000 times 4 houses, right? That you could essentially trade one house up to 4. But it's actually likely your capital is going to be greater than $160,000 because the tenant during that period of time is also paying the loan down. So your loan is also worth less. So maybe having an extra $20,000 from loan reduction. But it's all about being a strategic investor to understand how math and leverage works with real estate, and use that consistently over time to create your path to whatever you're trying to achieve financially.
I think a lot of people don't really understand the power of this, right? Because you put a down payment down, right? And you're buying a $200,000 property in this example, putting $40,000 down, finance it for 20, 30 years, whatever it is. In the meantime, you've got a couple of things happening. You've got rent coming in. That rent is paying down your loan, right? And hopefully the rent supports the debt service of the property, the insurance and taxes. It also supports any maintenance. You're cash flowing on top of that. You're also banking those dollars, right? And then in addition to that, you're raising rents over time because you can build into your leases escalations in rent, right? Now you want to be nice about that. You want to charge somebody 10% rent increase next year. But 2 or 3% is certainly fair, right?
Yeah.
And then on top of that, the property is appreciating in value. In addition to that, you can also depreciate the property. I mean, I really think that a lot of folks don't understand the full benefit of it. And I really commend what you guys do because I feel like you guys communicate that message really well.
Yeah, I appreciate that. We have an acronym here at Rent to Retirement. We use it for real estate. It's called the ideal investment. We didn't come up with this. I forget who we got it from, but it just fits well. And that's all the ways that you earn income, which you just nicely went through. So most people are focused on cash flow initially. And I think this is just your net cash flow at the end of the day, after all maintenance and management and debt service is paid, because in their mind, it's the most tangible thing where they're saying, hey, if I have $300 a month of cash flow on this property and I had 10 properties, that's $3,000 a month or $36,000 annually. That's going to cover my expenses. And hey, if I doubled that, then I doubled that. But the reality is, when you build wealth in real estate over time, letting time do what it does, it's all the other ways, all the other things that you just mentioned, Ryan, which really help to compound your wealth. So I is income. For the ideal investment, that's your cash flow. D is depreciation and tax benefits. E is equity buildup as the tenant pays the loan down. A is appreciation. And then L is using leverage, which leverage is just like such a huge tool in real estate. And I think that a lot of people don't understand the tax benefits around real estate as well. Like our goal, we run a very successful 8-figure business, and every year our goal is to buy enough real estate to offset our income 100%. And so that means that we're not paying any money to Uncle Sam legally, because we're doing what the IRS wants us to do, which is buy real estate, stimulate the economy, provide housing for people, because there's a national shortage of housing and affordability crisis. And then we're able to, keep more of our hard-earned money to then reinvest and buy additional assets that have additional streams of income and cash flow and additional tax benefits. And it's just this ongoing, that's how you snowball your way to wealth, is just consistently doing that over time. But you have to understand how it works. We have some creative ways we help people expedite that. For example, in the same example you used, we have lenders where you can put as little as 5% down on investment properties, like true investment properties. We're not talking about houses you live in or FHA loans. These are true portfolio loans. They're 30-year loans where you can buy properties with as little as 5% down, and you can own multiple of those loans. So like in that same example, you could, instead of putting 20% down on one property, you could put 20% down on 4 properties, putting 5% down on each. So these are just some of the, I know I'm spitballing here and getting off on tangents, but
It's
these are
great.
just some of the things.
Yeah, it's I mean, I love impromptu and just thought process and just thinking out loud. Let's jump in here. And I'm down to get into taxes too, because I am a huge believer. In retirement, taxes will be your biggest expense by a mile. It will be greater than healthcare expenses. We can be healthy, we can eat right, we can exercise, we can take our medications, we can, go get physicals and try to stay in shape. And to an extent, we can try to curb our healthcare costs. So we do have a little bit of control when it comes to healthcare. Not a ton in some cases, but a little bit of control. We have zero control over taxes. And our country is a train wreck with debt. And I hope President Trump can get it right. Whether that he does or doesn't remains to be seen. But we've got issues. And, taxes or we're the third best tax rate environment we've ever been in as a nation. Yet we are $36 trillion in debt, and that's excluding a lot of entitlements that are owed to people too. So I believe taxes are going to have to go up, right? So let's talk about taxes. I mean, I know that you get 27 years straight line depreciation on residential real estate properties in most cases. But you're telling me right now we can take advantage of something called bonus depreciation, right? But let's spend some time with that, and let's talk about how an everyday investor who maybe works a job at an Exxon or Chevron or Shell, Anadarko Petroleum was now Chevron, or these other companies that are out there, how they could use buying real estate, taking advantage of the depreciation to create tax benefits on their W-2 income.
Yeah, absolutely. I mean, this is one of my favorite topics to talk about. This is probably one of the most impactful things that has allowed us to grow our portfolio and create mass amounts of wealth in real estate just personally, is being a conscious investor around the tax benefits. I think most people, Ryan, to your point, are familiar that, hey, there's good tax benefits around real estate, but they don't understand the extent of how you can utilize this. So I'll just run through a scenario. I think math is sometimes the easiest way to understand some of these things. Well, first and foremost, on the straight line depreciation, you're right, residential assets are 27 and a half years, which, by the way, that's a huge tax benefit just from owning a property, in addition to all the other tax write-offs that you get on an investment property, your tax, your insurance, your management costs, your mortgage interest. Those are all, any maintenance you do, those are all in addition to depreciation, all things that you can write off against your income on the property. So if you had a portfolio of rentals that was earning $100,000 of income annually, that should be tax-free, called tax-free income, because of all the normal write-offs you get that everyone gets. And so that could be the equivalent of earning, say, $150,000, $160,000 or greater, depending where you live, of like W-2 earned income. So that's the first thing to think about, of like, that's significant, right? That's actually goes to your bottom line. That's like money you keep, tax-free income just from normal things with real estate. What a lot of sophisticated investors do, and what I do personally, what we help our investors do is think about how they can use additional tax benefits through real estate. A lot of people don't know this, but if you're under $100,000 income and it phases out at $150,000 of income, but you can take a $25,000 deduction against your active income. Anybody could do that. So that's the first thing to explore, and that's straight against your W-2. You don't need to be a real estate professional or anything like that. So you could do a cost segregation study there. What you're talking about with the bonus depreciation is on that 27 and a half years, you can accelerate a portion of that. And really what that boils down to is having an engineer do a report on the house, because not all things in the house are going to last 27 and a half years. And so what the IRS allows us to do currently is to take a portion of those things, which are detailed in a report, to say these carpet, roof, most things in the house are not going to last that long. You can bifurcate and basically determine those items, and then take the depreciation for those all in year one. Anyone can do this. Okay, anyone can take accelerated depreciation on the house, and you may want to do this if you have a lot of passive income on a property where you are paying taxes on that. So really what that boils down to in the numbers is, say on a $100,000 house, we usually run napkin math around 30%. That's a good napkin math of what you would expect to accelerate depreciation. So that means 30%, that $100,000 house, normally you'd separate land, but for simple purposes, we won't do that today. On the $100,000 house, you're going to get $100,000 of depreciation over 27 and a half years. That's like $3.3 thousand a year of depreciation when you write off against your cash flow if you did the normal schedule. You can take about 30% of that, give or take, depends on the study, in year one. So on a $100,000 house, 30% of it, call it $33,000 or whatever in year one, which is significant. Now, where this really gets exciting is you can take that $33,000 and apply it against your active income if you qualify as a real estate professional, or you go through a short-term loophole. I mean, we can get into the nitty-gritty of this if you'd like, but there's certain ways that you can qualify for that, where you can count that against your active income. This is something we help our investors do all the time. So think about this. If you bought $1 million worth of real estate, which you could use leverage, in theory, if you use some of our 5% down loans, you could buy $1 million worth of real estate for $50,000. Or if you put your normal 20% down, that's $200,000 to buy $1 million worth of real estate. 30% of that would be $300K that you could offset against your active income. And if you had $200,000 of income that year and you basically had a reported loss, that $100,000 carries forward to the next year. It doesn't just disappear. So these are just, I know I kind of went fast through this, but these are ways that a lot of investors are buying real estate to either eliminate or minimize their tax burden through their active job, their business, their W-2, whatever, to have more money to reinvest and continually grow your portfolio.
And that's awesome. So tell me this, and I get people asking me all the time. What is it that qualifies you to be the passive investor, the active investor in your real estate project, so you can write off more or get more tax breaks? But what do you have to do that?
And I'll make a clarification point, because what I was referring to is 100% bonus depreciation. I know this may be high level for some listeners. Of course, we're happy to spend time to walk your audience through this if we have calls with them or whatever, and kind of explain this further. We have a lot of information on our YouTube channel and podcast as well that we put out specifically around this, where we bring in our CPA team to explain it as well. But to be able to take the accelerated depreciation, and this year we're at 40%, was very likely we're going to be back at 100% bonus depreciation because of the 2017 Tax Act that's likely to be extended. And those are the numbers I was running through. To qualify as a real estate professional, which allows you to take your passive losses from real estate and offset your active income from whatever that source that is, you need to do one of two things, which is real estate professional, or operate it and self-manage it for the first year as a short-term rental. For real estate professional, there's specific criteria, and I'm just going off the top of my head. I don't have the IRS code in front of me, but you need like 750 hours of dedicated managerial time. It needs to be your main source of income. So if you're, an engineer that has a W-2, your own business, and that's your main source of income, you're likely not going to qualify for that. However, if you're married and your spouse is part-time or stay at home, that's a lot of times how we help our investors qualify, is like, hey, your spouse is going to be the property manager, right, and oversee your your actions or the management of the properties. Even though our teams may be physically managing them, they're still managing the portfolio as a whole. As long as they get those hours in, then you can qualify your spouse as a real estate professional and then be able to offset that against your potential active income.
So Zach, basically someone could work, your analogy engineer, and once they retire, they could certainly move into that role, right? And dedicate that much time to property management, sourcing properties, and being active in the real estate game and getting those credentials and those benefits.
Yeah, absolutely. And they don't even have to fully retire, right? Someone could work part-time as long as they're spending more hours and the majority of their income is coming from the real estate related activities. Then that would help them qualify. Of course, I'm not a CPA. Always check with your CPA, right? But that is a unique way. And for those that are W-2 and can't qualify as a real estate professional, we help people buy new construction assets that they operate as a short-term rental for the first year. And that allows them to not have to qualify as real estate professional. They can still, so you just buy short-term rentals that you actively manage. And then the next year you can either continue managing them or turn them over to our team to manage. And you can still take advantage of those tax advantages. And the last thing I'll say, Ryan, is that this is something that you don't have to, even if you don't qualify for it this year, a lot of people are buying real estate to plan for it in future years, because you can go back and do a cost segregation study on a property you bought years ago and still get 100% benefit from that depreciation schedule applied to your income this year. So this may be something just to be forward thinking about. If like, hey, I can't qualify this year, you could take some steps, especially buying rentals, to have a nice portfolio to qualify for those hours to meet this in a future year as well.
That's awesome. It's amazing. There's so much here and there's so much depth to these tax benefits. And one of the things people struggle with is I got to replace my income when I retire, right? Somebody making $120,000, $100,000 a year doesn't have to replace their income if they're contributing to a 401k. They're going to not pay payroll tax anymore, 7.65%, right? So that they're contributing 10% to a 401k and they're paying 7.65% in payroll tax. That's 17 grand that comes off the top that you don't need to have coming into the household to retire. But still, deductions are going to mean less. I think that exemptions will go away, and however they're going to do it, the tax rates may be lower, but they're going to find ways to tax you. IRMA is another one, income related, monthly adjusted amount with going to Medicare. There's so many ways. So a lot of the folks that we serve are looking for tax benefits that aren't there. And it seems like to me, with owning some real estate, there certainly could be some ways to do that. Now, go ahead, Zach.
Oh, I was just going to say to echo on your point, like if you look at the wealthy, and the tax code is always changing, and I agree with you, the taxes are not likely going down. If anything, out of necessity, they will go up over time. But if you just look at what the wealthy is doing, I mean, there's a lot of ways to do estate planning correctly and do different things to mitigate your current tax exposure as well as for your legacy for your children. Real estate has step-up basis. And we could spend a whole topic on this as well, Ryan, but you can defer capital gains in perpetuity going through 1031 exchanges, passing them on to your children. They get step-up basis that's forgiven. So but my point is, if you look at what the wealthy are doing and have currently been doing, real estate is an intricate part of pretty much everyone's portfolio to some degree for tax reasons in particular.
Yeah, it's some of my biggest personal wins financially have been from real estate for sure. Callie and I bought a lot. We're going to build a house, and the builder was quoting me $330 a foot to build this beautiful home. And I gave Callie some numbers to go with, and then we got to contract the home and build the property, and the builder hit us at $550 a foot. And I'm like, that's basically double what we're going to pay for the house. And so what do? We sold the lot and doubled our money in the lot and bought another home and did well. And I've got several instances of where, it may not have it seemed like it was going to work out on the front end, but it absolutely worked out on the back end. Had some really big home runs for real estate for sure. Zach, let's talk about this. Let's say that I've got money. Okay, I'm what we call at Allied Wealth, an IRA millionaire. All right, so all my money is in. I worked at an oil company, gas company, utility company, whatever type of company. I socked money away in my 401k. I left one job, so my 401k became available to roll over. I rolled it over into an IRA. I'm with Fidelity or Charles Schwab. And now I want to, I love what you guys are doing. I heard you on Ryan's podcast. How do I take those IRA dollars and put them to work in real estate?
There's a lot of different things you can do. But if you're rolling it over into like a self-directed IRA or a solo 401k, which allows you to basically have a little bit more control over your retirement account, where you can invest in assets like real estate, that's one way you could keep it in the retirement tax advantage account that you currently have been working towards, and still buy real estate. There's a lot of question marks on this, is much on an individual basis of like, does it make sense to keep it in the account? In some instances, it actually might make sense to take it out, or to take a loan against your 401k. There's options with that. But most people that have significant wealth in the IRA or 401k are going to keep it there. It's been a tax advantage. They don't want the penalties of taking it outside of that. So you can absolutely buy real estate within your account. If you're using leverage, there's some nuances with this. You have to use non-recourse debt, which might require a little bit more money down. All the income from the property needs to go back into the account, but you can still leverage within the account, which, maybe historically you haven't been able to. So that's something to think about. If you could leverage even at 50%, that's a lot of borrowing power that you can really increase your wealth within an already tax advantaged account. So definitely an individual approach. And I'm sure, Ryan, you help a lot of your clients to figure out a plan and strategy if that's the right way to go. But we have a lot of investors that are investing through a retirement account all the time.
Yeah, and they certainly can. And what Zach's getting there at there, folks, is it actually may make sense to take an IRA distribution. Depending on, if you're 59.5 years of age, you avoid a 10% early withdrawal penalty. You pay the tax. You're going to pay the tax at some point in time. Okay, there's two guarantees in life, and one of them is taxes. All right. And so you may be in a situation where your income tax bracket allows you to take the money out of the IRA, 12% tax rate. Take that 12% tax rate, pay it off. Now the property is owned outside of your IRA and now qualifies for additional tax benefits like depreciation. It also qualifies for step up in basis. The income coming in from the property is tax advantage as well. There's tax advantages you can achieve by actually going ahead and biting the bullet, so to speak, and paying Uncle Sam his share and taking the money out of the IRA, moving it over to a non-qualified account and accessing real estate investments from there. Just so many different ways to do this. And that brings you to another one, Zach. I mean, at Allied Wealth, our client base is largely 50 and up, but we got to plant seeds today to have crops tomorrow, right? Parable of the seed sower, right? So we also have to help people that are in their 30s and 40s build wealth. Because if we don't help them, when our company's here 100 years from now, we may not have any clients, right? So let's spend some time talking about barriers to entry, right? And so, if I'm 30, 40, maybe my 50s, what are some barriers to entry that you see? And how are some ways people can overcome those barriers to entry?
There's a lot of different barriers to entry into real estate for one reason or another. The biggest is mindset, Ryan, because people have preconceived notions around what real estate is, ways they can invest in real estate, how the math works, their schedule of investing. Yes, time is on your side with any form of investing you do. The sooner you get started, obviously over time things compound, especially when you're using leverage and investing in real estate. But I always tell people, and this is true of me and how we've been investing, like, nothing out there is really overnight success, right? Especially real estate. It's a time game. It's a long-term investing. I view real estate investing as a lifelong journey. And when my time on this earth is done, I'm hopefully have been invested in my children through education. So I'm not just handing them over this huge portfolio, but I taught them how to be, savvy investors so they can do their own things. But and that's a whole nother conversation. But there is, it's never too late to get started. I'll say that, even if you're later in life. I mean, we have a lot of people that are in the 60s and even 70s that are investing, that are in retirement years, and they're just really trying to optimize their retirement picture. You can create significant wealth in real estate in a few short, dedicated years, not overnight, but it also does not take a lifetime. Capital is an obvious barrier to entry. You have to have capital to invest. Although there's a lot of creative ways where you can minimize that capital. For example, the 5% down loan option, that may be an option for some people if they have limited capital. There's all sorts of other ways. Everyone runs out of cash at some point in time to buy real estate. I mean, a lot of people that we talk to. It's like, hey, if I had $1 million to invest and bought this huge portfolio tomorrow, like great, I'd be retired. But that's not the case for most people. So we do need to be creative with people to work through, well, what are these other resources once your cash runs out? Maybe you do have a retirement account that you could tap into. Maybe you have a primary residence that has equity that you can use a HELOC to further investing, because there is such a thing as return on equity. And if your equity is in your house, it's not working for you, right? Your return on equity goes down. Sorry, I cut you off, Ryan. What were you going to say?
What I was going to say too is that, if you're hearing this, you're trying to figure out how to get in. One of the things that I did is I went and got a real estate license, and then I had a situation to where I would buy a property, and I got paid a commission, and I used that commission as part of a down payment, and that's you can do that, right? Getting creative here is important, and you can tap equity in your home, as you're saying. I didn't mean to cut you off. I just wanted to jump in there, Zach, because I actually did that early on in my career. At one point in time, I had several rental properties, and that's how I acquired my first rental property, was that real estate commission.
And that's you being a hustler, right? Real estate can also be a side hustle. That's how it started with me. And now we run this large business. This is never an intention, but real estate started as a side hustle, just like you, because and I wasn't an agent. I don't think you have to be, to be an investor. But that's just, it can be a side hustle that you can still work your full-time job and still have these investments that you're building over time, because it is a lifelong journey. And I'll say this on the barrier of entry, and this is exactly what our company aims to help people out with, is limiting beliefs around starting to invest, because either one, they live in an expensive market. So a lot of people just don't invest in real estate because their local market is too expensive, or it's inaccessible, or just too competitive. All right, well, if that's the case, well, then look elsewhere. Well, how do you look out? There's so many other places just to look. You got to build your team. You don't know an area. How do you know a property is going to be performing well across the country? I mean, that's exactly what our team helps people with. So limited time, that's another barrier to entry. People are like, I'm so busy. I want to spend more time with family. I don't want to have a rental property I have to manage. I don't want to buy myself another job. Well, again, this is meant to be more on the passive end of real estate investing. So our team handles everything for them. So we try to look at all those barriers of entry and find creative ways to help people advance their goals if they're truly motivated to get into real estate.
And that really is awesome. So let's, the other thing we mentioned was capital, right? We talked a little bit about down payment. I mentioned how being a hustler, I got a real estate license and got my first property that way. But what about financing? Like I've got the down payment. Let's spend some time talking about financing, because you said something really attractive to me personally. Actually, I wasn't aware there's 5% down loans right now. I understand leverage. I understand it well, and I'm shocked to hear that. So let's spend some time talking about different financing structures that people can use here to realize their dreams in real estate.
Absolutely. And we don't care what financing you use. Our goal is to put you in touch with a lender, if you don't already have one, that's going to best allow you to accomplish your goals and expedite your success. Most people, when they think about investing or buying an investment property, they think in conventional loans. So these would be your Fannie Mae, Freddie Mac loans, because that's what most people have either had experience with or are familiar with. And that traditional way of buying real estate is putting 20% down on a single family as a minimum. Some options you can get down to 15%. Then you have mortgage insurance you're paying, or 25% down on a multifamily property, which we mainly focus on single family. We do have some small multifamily, like 2 to 4 units, but there's a whole plethora of other loan options out there that I would say that most people are just unfamiliar with on what they are, and most importantly, how they can use them to scale their portfolio. And it's very individualistic. It's all about matching the right loan options with the right person, and that person needs to be educated to know what are their options first and foremost. So that's what we help people walk through. But there's DSCR loans, your debt service coverage ratio loans, where they're not looking, banks are financing the property based on the property performance, the cash flow. So they're not necessarily underwriting you as the investor. If you can't qualify for conventional, say you're a self-employed business owner, or you're doing all these tax creative things to not show income on your taxes, maybe you don't qualify for conventional. Or if you maxed out your loans on conventional, because you can have 10 under your name at any point in time, or if you and your spouse did them separately, you could have 20. But let's say
and make sure you do that, folks. Don't go do joint loans if you're doing this stuff. Put 10 loans in your name and 10 loans in your wife's name.
And you can still joint own the property on title, but if you can qualify separately, certainly that's, I think, a better way to do it. To your point, Ryan, because conventional loans, generally speaking, they're a 30-year fixed loan, And that's things are kind of wonky today, but generally speaking, those are the best loan options, is why people want to start with those. But there's portfolio loans out there. There's non-recourse loans where you're not personally guaranteeing it. Those are like through investing through your retirement account. We have a lot of these local credit unions that we build relationships with to offer loan products specifically to our clients. So I keep bringing up the 5% down option. That is exactly that. That's a portfolio loan where you can qualify. You still have to financially qualify. You still personally guarantee that, but the bank will leverage up to 95% of the property. It's a 30-year loan, and there's no mortgage insurance. There's no PMI.
That's incredible.
And there's no prepayment penalty. So the rate's a little bit higher because the loan amount's higher, but you can also refinance that at any point in the future. So it's just understanding the options and then building a strategy.
I think it's important to mention that. You said the rate's higher, right? So some people may look at it as, well, wait a minute, Ryan, I'm paying, 3% on my house now. You're telling me to go buy this property and the mortgage rate's 8%. And, I think people understand that doesn't matter. It doesn't matter. If the property payment is $1,000 a month with an 8% mortgage rate and the property's paying you $2,000 a month in rent, the interest rate doesn't matter. Plus, you can deduct a portion of that mortgage interest. So what you have to look at here is what we call your after-tax cost of capital, because your after-tax cost of capital may not actually be 8%. So if you could deduct a certain percentage of your interest on an 8% loan, you're actually maybe only paying 6% interest after deductions. And I think a lot of people get caught up on stuff like that, Zach. And it just, I think in some instances we get fearful and we kind of step over, pennies to not make dollars. What do you say to that, bud?
Well, I agree with you first and foremost, but it's all about understanding the math. And most people have not gone through the practice of actually writing out the math and understanding how it works. Because once you understand it, it of course makes sense. But yes, on the surface, people say, oh, high interest rate, right? Interest rates are just an input output, to your point. It's just an evaluation. It's one of multiple inputs into a property evaluation. And if your property is still cash flowing positively, you're still producing income with that interest rate, then yes, it doesn't matter. Also, interest rates are just a point in time. They are relatively high relative to where we were a few years ago, but in the grand schemes of things, rates are really not that high. If you think back about 80s and sometimes in the 90s where there's 17, 18% or interest rates on mortgages, which is crazy to think about. And people were still investing and making great money then. But the point is just understand the math. And if the cash flow covers all of the expenses, then it doesn't matter. And you can always refinance the property in the future. So if the interest rates go down, then in theory, you could lower your interest rate then and increase the cash flow incrementally from that. But leverage is such an important tool to think about when factoring in. And in real estate in general, think about this concept for a minute, just big picture. In real estate investing, you are buying a house that you are bringing a very small portion of the money to the table to own, but you get 100% of the benefits from it. You get 100% of the tax benefits, you get 100% of the income, you get 100% ownership of the property. You're partnering with a bank who's going to bring the majority of the money to the table, and someone else is paying that off for you, i.e. the tenant, right? So you literally are buying an asset that you get 100% control, benefits, and income from, that you're partnering with the bank to bring the majority of the money to buy that someone else is paying off for you. What other asset class can you do that with?
You can't. You take $100,000, you put it in the stock market, and you have 100% of the risk of the stock market. You take $100,000 and put it into, in your case, with a 5% loan, you could buy potentially 20 properties over a period of time. I've certainly got to build that up a little bit, but the risk is that your 5% of capital is exposed to the property, and just the risk isn't there in relation to the market. The real estate market, we had the 2008, 2009 financial crisis, and I don't see that. I don't see it happening again. There was a lot going on there with the CDOs and leveraged collateralized debt obligations and the insurance provided on those things. The adjustable rate mortgage market was insane. We had, you may not know this, but at one point in time, I owned a mortgage company and a real estate brokerage. And so we were, I remember a lender back in that day, Mila was their name. They were doing a 560 credit score loan, 106% financing, stated income. So a 560 credit score loan, 106% financing with stated income basically means, hey, can you breathe on this mirror and make some fog? If you do, we will give you this loan. And then they were doing this on adjustable rate mortgages. So what was happening is people were getting these teaser rates of 3%. And they had to get that teaser rate of 3% to be able to qualify for the loan based on their debt to income ratio. All right. But then what would happen is 2 years later, 3 years later, that rate would skyrocket. Now, the intent was for capital to be in the system to allow people to refinance properties. But what they didn't take into account is, hey, the neighbor's got the new Ford Explorer in the driveway, and the neighbor put the pool in, and the neighbor got new furniture. Well, I want all those things too. So people went out and bought furniture. They bought the Ford Explorer. They bought the pool. They financed all that stuff. So now they're in a situation where no matter what happened, they couldn't qualify debt to income ratio wise. This blew up in the face of the country, and we had what happened in 2008, 2009. Can you kind of speak to what, are we in a situation to where that risk is still prevalent in the markets today? Or do you think that's been curbed a bit with regulation or lending guidelines, or some thoughts on that?
Yeah, well, significantly to your point. I mean, those loans are non-existent for good reason. And yes, you're not just over leveraging, because that's the question. All right, so what are the risks here, right? What are the risks with buying real estate in general, with over leveraging? The lending dynamic today is significantly different, and you do need to qualify well for loans. You need to have reserves. You have to have good credit. You need money down. But I would say that, so no, I don't think that in every market cycle is different, and it's night and day different, right? We will always have fluctuations in market cycles. I think I read a stat the other day, like during, out of all the past recessions going back, I think it was 70 years, real estate has only lost value during 3 of them. Or no, it was 4 of them, and during 3 years, and 3 of those, or 4 years, and 3 of the 4 years were around the 2008 period of time. But that was a completely unique scenario. But the bigger picture is that you need to invest in real estate for the fundamentals. That was a lot of speculation, unsophistication in investors. They were buying properties assuming they were going up, in addition to over leveraging them with these crazy loans and not being in a good financial spot to service the debt on those loans. There's a lot of people that did very well during the 2008 period of time. A lot of people that bought discounted properties that now have multi-million-dollar portfolios. But regardless of that, there's a lot of people that had just plain rental properties that did just completely fine because they were adhering to the fundamentals of real estate, which is buy in a good market with a good team where the property is cash flowing well to cover the debt and all the expenses on it. It really doesn't matter. You got to think about real estate as a long-term investing game, because all real estate goes up over time, thanks to inflation and all these other things. It's, by the way, in high inflationary environments, you need to own physical assets because it benefits you. Actual rents and prices go up, and when you own assets, that's to your advantage to hedge inflation. But if you're investing for fundamentals of real estate, which is buying cash flowing assets, it doesn't matter what the market's doing. It doesn't matter what the price of that property is at any given point in time, because the property is producing income. People always need a place to live. And guess what? In turmoil economic environments, there's more renters than there are homeowners, now being one of them. So anyways, that's what I have to say about that market cycle. But really, in general, anytime, buy for the long term, buy with the fundamentals of real estate, where your property is in a good location with a good team, where it's cash flowing well. The market's going to do what the market's going to do. But over time, certainly that asset is going to be worth significantly more than when you bought it.
Yeah, I agree with you on that. And I think a lot of people fail to realize that when you're buying real estate for investment purposes, it's all about cash flow. It's all about the income. Like, we have a concept called cap rates, capitalization rates on properties. And the capitalization rate has nothing to do with anything about the property except the net operating income of the property. That's it. And so if the net operating of the income of the property is there and the cap rate's X, the property value is this based on income. And that income should sustain itself regardless of what happens in the market cycle of values, right? So, and as you said, you're going to ebb and flow. Zach, I got one more question for you. I know we're coming up on time here, and I've really appreciated this. This has been a great interview. I think we kind of digressed a little bit from what we were going to talk about originally, but this has been great. I got a theory, and I want to run this past you. So, people bought homes with rates that I think my rate of my last house was 2%, right? And a lot of people have 2% and 3% rates to get a property today, you're probably paying 6.5, maybe 7 in some cases. So I think people are, with these low rates, they're going to be hard pressed to sell that property and move on to a newer property and pay a higher rate of interest. And I'm talking more from your primary residence standpoint, right? Not an investment standpoint. So I kind of feel like, I know the property of choice for your program is new construction. And the reason why I'm saying this is I feel like people that are in houses that are built, I kind of think that market's going to be locked up for a while. And I think the new construction market is going to kind of separate itself from the market that's owned by people who rent or who live there for primary residences with lower interest rates. And I think the new construction market may actually appreciate more as a result of that. What are your thoughts on that?
I think it's hard to draw general assumptions across the nation as a whole. I think there's a lot of truth in validity in what you just stated, Ryan, and I agree with your conclusion for the most part. I think it's really market dependent, though. Like we talked about in the beginning, supply and demand is vitally important. We are at an all-time high for deficit of housing. We have a deficit of like 7.5 million houses that are needed in the U.S. There's an affordability crisis as well that also factors into this. Where especially because of interest rates and inflation and all the other things, like it's more unaffordable now to buy a house for someone to live in than it ever has been. And so there's a lot of factors into this, but like affordable housing, and I'm not talking about low income housing. I'm just talking about like generally affordable housing, which is the space that we play in, is going to be in the highest demand that it's going to be, and demand drives appreciation. And so we've seen, there's been some markets that we operate in, mainly the Southeast. We work Midwest and Southeast. A lot of the Southeast markets like Texas, Georgia, Florida, Alabama, Carolinas. These are areas where we're building new houses for rental purposes, and then leasing them, and our investors are buying them. These are areas that are in that $200,000 to $300,000 range. That is the highest demand for housing because it is affordable. These are still nice houses. These are not low-income houses. These are A-class neighborhoods that attract very quality tenants and are quality built with builder warranties and all the things. But I think that new construction builders are building in areas that have an undersupply of housing for a reason, because there's a huge population shift to that area. To your point, the market stagnated for the past couple of years in general because there hasn't been a lot of, there's not been a lot of properties on the market because people are holding on to them. One, because they can't move to an area and replace with their current income or a current mortgage, but also they don't want to sell that house. So all that being said, it does drive more of a demand in the new construction space. Those houses are appreciating greater than they have historically. Also the rents are increasing larger. And with all the builders combined across the country, we cannot keep up with the demand with houses that are needed. So I think it's an excellent asset class to invest in for multiple reasons. Plus, you don't have, you're not, even with a rehabbed house that's 50 years old, you don't have the foundation and the possible maintenance issues that come up with that. A new house is a new house. So lots of reasons for that.
Zach, that's awesome, man. Well, listen, tell me what's next for you and rent to retirement, and talk to us for a second about your academy.
Yeah, absolutely. We're always doing fun stuff. The academy itself is a newer venture for us. And this is basically our educational platform, Ryan, where we assist investors in building a strategic plan. They have some coaching involved with that. We walk in, it's a 90-day course. They take at their own pace. There's group and individual coaching calls with that. They get a lot of benefits. You do not have to join the academy to invest through our platform. Anyone can invest through our platform and visit our website. But the academy is a program that we've helped, is just been more intentional about helping people map out a plan, regardless of your experience level, building a strategy around investing, starting very fundamentally, and getting to very advanced investing. So by the time you complete the coursework on that, you have a very deep understanding of investment in real estate and a solidified plan that you hopefully will execute with our assistance. So we're always opening up new markets. We're excited about the future in real estate. We're looking for some additional tax deductions that hopefully we'll see throughout this year. We're excited about. So we're just having a lot of fun doing what we're doing and helping people see the light in real estate, because it's been such a paramount contribution to our life that's allowed us to live a life that, and we had high paying career paths, my wife and I, but now we're able to have a global impact on eye care and do all these other things that we wouldn't have been able to otherwise. So we're just having fun doing what we're doing.
That's awesome, Zach. Zach, tell us this: how do people stay connected to you guys?
Definitely the website, I think, is the best place to go, Ryan. That's rent2retirement.com, rent-to-retirement.com. We have our own podcast and YouTube channel. We put out a lot of information about real estate investing, leverage, market analysis. They can also text, if you're listening to this, you can text REI to 33777 and set up a time to meet with our team. We're here to add value. We don't charge investors anything to work with us. We make our money from building, selling, managing houses. But our goal is to always add value to everyone that we speak with and help you understand real estate and build a strategy on how you can use real estate to accomplish your goals.
Zach, that's so awesome. Well, folks, thank you so much, Zach, for stopping by today. I really appreciate it. And folks, I hope you got a tremendous amount of value out of today's podcast. I know I got some value out of this thing for sure. If you want to connect with Zach, he dropped the lines on how to do that. Feel free to do it. I think real estate is a great part of anyone's portfolio, and it's absolutely something you should look at, whether you're in your 20s, 30s, 40s, or 50s. The time to get started is now. There's no time like the present to get going. So thanks so much for stopping by the episode today, folks. We'll be back next week with more. Subscribe to Redefine Retirement on YouTube, Spotify, or wherever you listen to podcasts.